Welcome to today's deep dive. We're really glad you're joining us today because, well, today we are tearing into a financial crossroad that honestly sneaks up on a lot of professionals.
Mm, yeah, it really does.
Right. You hit that roughly $100,000 mark in annual income, and suddenly the whole financial landscape shifts. I
Yeah.
mean, it's a fantastic milestone, obviously, but it pushes you right into what tax planners consider to be a highly sensitive zone.
It is. It's a highly sensitive zone.
Because at 100K, your tax strategy finally starts to matter in a quantifiable compound interest sort of way. And the key thing here is you aren't yet locked out of the best tax-advantaged vehicles available to individual investors.
And that's the thing people miss.
Yeah.
Up until this point, making maybe 60 or 70,000, most financial advice is almost entirely behavioral.
Right. Just save.
Exactly. Just get into the habit of saving, get your employer match, pay down high-interest debt. Right, the basics. But crossing that six-figure threshold is where generic advice actually starts to break down. And if you aren't careful, it can cause structural inefficiencies in how you build wealth.
Which is exactly why we are pulling from, we have a really brilliant evergreen editorial today from the Daily Fiscal.
It's a great piece.
It is. It's titled Traditional IRA versus Roth IRA for $100 K earners. The math verdict. And our mission today is to really move past that tired conventional wisdom of, just use a Roth when you're young.
Because it's too simplistic.
Way too simplistic. We want to look at the actual marginal tax mechanics, so we are going to explore a very specific structural trap built into the tax code that is currently costing single earners well over $87,000 in unnecessary lifetime taxes.
That number always gets people's attention.
It does, over $87,000.
Wow.
And we're going to lay out the precise math you need to evaluate your own path. Okay, let's unpack this. I'm really excited to get into these numbers.
Well, I'm glad one of us is excited about the tax code, but it really is a math problem, not a sentiment problem. We know our listeners already understand the basic mechanics of pre-tax versus post-tax accounts.
Right, we're not starting from scratch here.
Exactly. So we aren't going to sit here and define what a traditional or Roth IRA is. Instead, we are going to look at the friction points. What happens when those accounts collide with the 2026 IRS phase-out thresholds? Because that is where the real money is either made or lost.
Okay, so let's establish the parameters of what the article calls the decision zone. If you are a single filer making around $100,000 in 2026, the door to a Roth IRA is completely wide open.
Wide open.
The IRS phase-out for direct Roth contributions, it doesn't even begin until you hit $150,000 in modified adjusted gross income.
MBI.
Right, MEGI. And it cuts off entirely at $165,000. So at $100K, you are comfortably in the clear. And for 2026, the rules state you can contribute a combined total of $7,000 across all IRAs.
Or $8,000 if you're 50 or older.
Right. So the central conflict is obviously where to direct that $7,000.
And to figure that out, the golden rule of tax planning relies entirely on the marginal rate spread.
Yeah.
You are comparing your current marginal tax rate against your anticipated marginal tax rate in retirement.
Current versus future.
Exactly. If you project your future tax rate to be higher, historical modeling shows the Roth IRA generally wins. Post-tax contribution, tax-free growth, tax-free withdrawal.
Yep.
But if you project your future rate to be lower, the traditional IRA historically wins. You take the pre-tax deduction at a high rate today, get the tax-deferred growth, and pay ordinary income taxes at a lower rate tomorrow.
And if they're equal, they're mathematically similar, assuming identical growth. But I want to pause right there. Let's dig into that word marginal, because the key thing here is not confusing your marginal rate with your effective tax rate.
Oh, this happens all the time.
It's where so many $100,000 earners mess up their spreadsheets. Let's say you earn exactly $100,000 in gross income in 2026. Single filer. You take the standard deduction.
Which is roughly $15,000.
Right, leaving you with a taxable income of $85,000. Now, your effective tax rate, which is the actual blended average you pay across all your income brackets.
The percentage of your total income that actually goes to the IRS.
Right. That's only about 14.8%.
And it is so tempting to plug that 14.8% into a retirement calculator.
It's so tempting, but it's mathematically incorrect. because this $7,000 IRA contribution comes right off the top of your income. That last dollar you earned is sitting squarely in the 22% marginal federal tax bracket.
That 22% rate is the entire battleground.
It is. You are either saving 22 cents on the dollar today by deferring it, or you are locking in a 22% tax payment today to shield it forever.
And that distinction is paramount. If we assume investment growth and time horizons are identical, the math hinges entirely on what happens to that 22% rate down the line.
Right.
But the source material highlights something that completely overrides this golden rule for this specific income bracket. The author calls it the deductibility trap.
Oh, here is where it gets really interesting. Because this is the hidden landmine most financial articles just completely skip over. It's tied directly to your workplace benefits.
Specifically, your workplace 401k. A lot of people miss the deductibility trap because they assume that if they put money into a traditional IRA, they automatically get a tax deduction.
Which makes sense. That's what traditional implies.
Exactly. But if you are a single filer in 2026 and you have access to a retirement plan at work, like a 401k or a 403b, the IRS heavily restricts your ability to double dip on pre-tax benefits.
The phase-out math on this is brutal.
It is. Your ability to deduct your traditional IRA contribution begins to phase out at $79,000 of MBI, and it drops to absolute zero at $89,000.
Which means if you're a $100,000 earner, you've already crossed the tripwire. You're over the $89K limit. So a traditional IRA contribution becomes entirely non-deductible.
And that's the thing people miss. You get zero upfront tax benefit.
Yeah.
You cannot subtract a single dime of that $7,000 from your taxable income this year.
So think about what that means. You are taking after-tax money you already paid that 22% marginal rate on.
Right.
And you are putting it into a traditional IRA. So you're funding it exactly the same way you would fund a Roth IRA post-tax.
Right.
But the back-end treatment is, it's universally bad math.
It fundamentally shifts the recommendation. It creates the absolute worst of both worlds.
Yes.
With a non-deductible traditional IRA, yes, the IRS allows you to withdraw your initial contributions tax-free in retirement because you already paid taxes on the basis. But all the investment growth over the next 30 or 40 years, that will be taxed as ordinary income when you withdraw it. You feel the tax pain today by using post-tax dollars, but you completely forfeit the tax-free growth of the Roth. You still have to pay taxes on the growth at the back end.
It is a fundamentally awful outcome for this specific bracket. You are no longer choosing between a deductible traditional IRA and a Roth. You're choosing between a non-deductible traditional IRA and a Roth.
Exactly.
Let's bring this to life with the specific example from the source, because they run a 32-year projection that is, well, it's pretty staggering. They introduce us to Jordan.
Right, the UX designer.
Jordan, 35 years old, UX designer in Portland, earning $103,400 with a workplace 401k.
So Jordan is squarely in the decision zone, caught right in the middle of that deductibility trap.
Right. And Jordan decides to max out an IRA with $7,000 annually for 32 years, right up until retirement at age 67.
Consistent saving.
It's very consistent. Over those 3 decades, Jordan contributes $224,000 out of pocket. Assuming a historical 7.3% average annual return, that account balances out at $1.09 million at retirement.
Which is a phenomenal outcome just from a pure accumulation standpoint.
Huge. And the key thing here is the divergence in how that $1.09 million is taxed. Let's run the Roth path first. Jordan pays the 22% marginal tax today.
Yep.
Puts the post-tax $7,000 into the Roth each year. At age 67, Jordan gets that entire $1.09 million completely tax-free. No tax on the basis, no tax on the growth. Done.
Now let's analyze the alternative. Let's say Jordan opted for the traditional IRA, maybe just defaulted to the first option on the brokerage platform. Because of the income level and the workplace 401k, this is a non-deductible traditional IRA.
The trap.
The trap. Jordan still contributes $224,000 of after-tax money. At age 67, the gross balance is the same, $1.09 million.
But when Jordan goes to withdraw that money, the original $224,000 comes out tax-free. But the growth, the $866,000 in compounded investment gains, is entirely taxable as ordinary income.
And if we connect this to the bigger picture, our analysis suggests a massive tax liability here. In the model scenario from the article, the author assumes Jordan has an effective tax rate in retirement of 18%.
To account for Social Security and 401k distributions overlapping.
Exactly. Applying that estimated 18% rate to the $866,000 in growth means Jordan owes the IRS $155,880 in retirement taxes.
That is over $156,000 lost, simply because Jordan triggered the deductibility trap and used the wrong tax wrapper for 3 decades. I mean, the gap in after-tax value is insane.
It is. But we do need to provide some important context here. Individual outcomes depend on future tax rates, which cannot be predicted.
Fair point.
That $156,000 gap relies on the modeled assumption of an 18% effective rate in retirement. But even if Jordan's future tax rate were lower, paying ordinary income tax on 3 decades of growth, when a tax-free alternative was sitting right there, is mathematically suboptimal.
Right. Why pay anything on the growth if you don't have to? Which actually brings us to the most pressing variable in this entire current versus future marginal rate equation, the massive legislative elephant in the room,
The TCJA sunset.
the Tax Cuts and Jobs Act of 2017. Looking ahead to 2026, this is a wild card.
It's the wild card. Without congressional action, the TCJA is scheduled to sunset on December 31st, 2025.
Which means the brackets automatically rise.
Automatically. The legislation was structured so the individual rate cuts were temporary. So that 22% bracket where our $100,000 earner's last dollar sits reverts to 25%.
A 3% jump right off the bat.
Right. The 24% bracket goes back to 28%. The 32% climbs to 33%.
So what does this actually mean for the listener right now?
Well, we always caution against making permanent financial decisions based purely on policy speculation.
Of course, Congress could change it tomorrow.
Exactly. But evaluating the law as it is written today means acknowledging that today's 22% marginal rate might be an anomaly. It might be the lowest we see for a generation.
Right. Paying taxes now via a Roth might be locking in an incredibly favorable rate before a legislative hike, which makes the Roth even more appealing right now for this specific bracket.
It certainly reinforces the argument, and I want to be fair to the other side here, financial planning is never absolute. So what does this all mean? Is the traditional IRA just dead for 100K earners?
That's a great question. And no, it's not. The source material meticulously outlines 3 specific scenarios where the traditional IRA still wins.
Let's give these fair airtime. Starting with scenario A, no workplace plan.
Right. So the entire deductibility trap we just unpacked, it only triggers if you or your spouse are covered by a workplace plan, like a 401k. If you are an independent contractor or your company just doesn't offer a plan, those strict phase-out rules vanish.
You get the full deduction.
You deduct the full $7,000. You successfully defer taxes from a 22% rate down to potentially much lower in retirement. The math reverts to a highly efficient deferral strategy.
Exactly. Then there's scenario B, which is state tax arbitrage.
Oh, I love this one. The math on this is beautiful.
It really is. State taxes can wildly distort the marginal rate spread. Let's say you live in a high-tax state today, like California at 13.3% or New York at 10.9%.
You add that to your federal 22% bracket, and your combined marginal tax rate today could be over 35%.
Right. Now, if you plan to retire in a state with no income tax,
Like Florida or Texas.
exactly. If you fund a Roth IRA while living in New York, you are paying that combined 35% tax rate today. But if you utilize a deductible traditional IRA, assuming you don't have a 401k, you defer that 35% hit.
And 30 years later, you're a resident of Florida. When you withdraw the money, New York can't tax it. You only pay the federal rate, which might just be 22% or lower.
Paying 35% plus today to avoid 22% tomorrow is a massive mistake. Traditional wins clearly here.
Absolutely. And what's the third scenario?
Scenario C is lower retirement income. If you anticipate a structural drop in your income needs during retirement, say you step down to part-time work, or your projected income falls below roughly $37,000 a year.
Which would drop you into the 12% federal bracket.
Right. Deferring taxes at your current 22% marginal rate, allowing the capital to compound, and withdrawing it at 12% is mathematically sound.
A textbook 10% spread in your favor. So we've covered the theory. But knowledge of the tax code is useless if you don't actually execute. The article concludes with a really practical 30-day action plan, because this stuff can cause analysis paralysis.
It definitely can. Step 1 is simple. Check your MAGI.
Not your gross salary.
Right. Do not rely on estimates. Pull up your most recent Form 1040 and look at line 11. You need to know exactly where you sit relative to that $79,000 to $89,000 phase-out window.
Step 2. Confirm your deductibility status. If you have a 401k and your NGI is over 89 grand, you are in the trap. Your traditional contributions will be non-deductible. If that's the case, our analysis suggests it may be worth researching a pivot to a Roth IRA.
Just to ensure you aren't paying ordinary income tax on decades of growth.
Right. Step 3, the platform logistics. You need to research a zero-fee platform.
Fidelity, Vanguard, Schwab, M1. The landscape is totally commoditized now. The specific logo matters way less than simply taking the action to open the account.
But step 4, this is the crux of it. This is where the behavioral errors happen. You can't just transfer the cash and log off. You have to actually invest it.
And that's the thing people miss. We see this constantly. Someone transfers 7 grand into a Roth IRA. They feel great about it.
They check the box.
Right, but they never actually purchase an asset. The money just sits in a cash sweep account, earning nominal yield, completely missing out on market growth. You have to deploy that capital.
The best way to avoid that is automation. Set up an automated pull for $583 a month. 583 times 12 hits that $7,000 limit seamlessly. The money moves, buys the index fund, and compounds in the background.
That systemic automation is the dividing line between earners who just save money and earners who actually build wealth.
So to recap the core message here, 100K is a tricky decision zone. The tax code is no longer just a backdrop. It's an active variable in your net worth. Don't blindly follow rules of thumb. Check your specific 401k status and your MAGI.
And as a reminder, while we've modeled these outcomes based on current law, your personal situation is unique. We strongly encourage you to run these scenarios with a fee-only financial advisor or a licensed tax professional.
Definitely. Evaluate these strategies within your full financial picture. Now, before we sign off, I want to leave you with one final kind of provocative thought to chew on.
Oh, boy.
We've modeled all of this assuming the U.S. government continues to rely primarily on income taxes.
Right.
But what if, 30 years from now, changing demographics, shrinking worker ratios, massive national debt force, a shift toward a federal consumption tax or wealth tax?
A complete paradigm shift.
Exactly. If they shift away from taxing income and start taxing consumption or net worth, regardless of the account wrapper, how would that change the value of these pre-tax and post-tax buckets?
It would completely dilute the utility of a Roth's tax-free withdrawal. It's a stark reminder that regulatory risk is the one variable we just can't model perfectly.
It's definitely something to chew on while you check your MAGI this week. Thank you so much for joining us for today's deep dive. Keep scrutinizing the math, and we will catch you next time.